Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update: Geopolitics, FOMO, and Tech Earnings, May 1, 2026. This video presents a direct informational narration of the source document. All right, let's jump right into it. The start of May is giving us a pretty complex landscape to navigate. We're seeing a real divergence among the three major U.S. stock indices. While the S&P 500 and the Nasdaq are flexing their muscles and repeatedly hitting new highs, the Dow Jones is telling a totally different story. It's showing some notable weakness, fading pretty fast after just a brief burst of resilience.
So here is our roadmap for today's explainer. First up, we'll dive into macro and geopolitics. Then, we'll shift gears to market technicals and FOMO. And finally, we'll wrap things up with a corporate earnings review. Let's get right to it. Section 1. Macro and Geopolitics. We're going to be navigating global oil and conflict risks.
Now, looking at the timeline of recent events, the market is currently chewing on some serious uncertainty, mostly driven by conflicting media reports. Initially, word got out that Iran sent a new negotiation proposal to the U.S. through Pakistan. That naturally raised hopes for a peaceful resolution and, for a moment, suppressed oil prices. But, this oscillating political messaging is essentially just noise, and it acts as a massive trigger for high-frequency algorithmic trading. For instance, midday reports came out saying former President Trump wasn't happy with Iran's latest proposal. Bam! Oil prices abruptly bounced back. But then, literally just minutes later, his statements completely shifted to reporting progress after a phone call, emphasizing a personal preference to avoid further military action. This kind of rapid whiplash is exactly what induces the renewed oil volatility we're seeing. Ultimately, though, the core consensus in the market is pretty straightforward. Everyone is just hoping to prevent active conflict, looking for an outcome where both sides can basically declare a localized win.
An absolutely crucial variable in this whole dynamic is Israel's strategic posture. According to Israeli Channel 12, officials over there are assessing that US-Iran talks could break down as early as next week. Because of that, the Israeli military is really ramping up preparations to independently neutralize the uranium threat if diplomacy fails to remove the materials and halt enrichment. To put this into perspective, Iran currently holds about 400 kilograms of 60% enriched uranium. That is enough material to build 11 nuclear bombs. For Israel, this represents an existential survival crisis, and they've made it crystal clear that military action will be necessary to hit their objectives if these negotiations fall apart.
Compounding all these geopolitical jitters is the actual state of our global crude oil inventories. Data from JP Morgan gives us a pretty stark warning. The idea that we have this abundant, overflowing global oil supply is, frankly, an illusion. Sure, if you look at the total inventory, it says 8.4 billion barrels. 6.6 billion of that is stored on land, and 1.8 billion is floating at sea. But here's the kicker. When we narrow it down to the actual accessible supply, that number drops all the way down to just 0.8 billion barrels, and 0.28 billion of that is already consumed. So JP Morgan concludes that if we see a blockade of the Strait of Hormuz extending until September of this year, commercial crude inventories are going to hit their operational baselines. That poses a massive, severe, systemic risk of failure to the entire global oil distribution system.
And despite those glaring systemic risks, plus some heavy direct political pressure from the White House demanding more output to curb inflation, the major U.S. oil companies are standing their ground with strict corporate strategies. Energy giants like ExxonMobil and Chevron are flat out refusing to boost their production capacity. Instead, what are they doing? They're laser focused on growing their free cash flow and maximizing their refining margins so they can scoop up those high price premiums on diesel and other refined products. From a corporate perspective, they're maximizing profits and fundamentally refusing to absorb policy-driven inflation risks on behalf of the government.
Moving on to Section 2, Market Technicals and FOMO. Let's dig into index levels and psychological pressures.
So, the S&P 500 has been flexing some incredible strength lately, logging 5 consecutive weeks of gains. In fact, it just had its strongest April in 6 whole years, thanks in large part to the massive AI narrative and some really solid corporate earnings. But, here's where it gets a little sketchy. A significant warning sign, what technical analysts call an inverted hammer pattern, just flashed on the daily chart. Following a gap-up open, this pattern structurally looks a lot like a lightning rod, and it serves as a critical signal to increase vigilance. The index recently hit an intraday level of 7,272, and the projections suggest the ultimate peak level for this current rally might be sitting right around 7,350. That's less than 100 points away from recent highs. The distinct structural risk here is that if big institutional investors all eye 7,350 as a primary exit point, they might preemptively front-run this expectation, triggering accelerated selling pressure before the target is actually realized.
The accelerated topping phase of a market rally creates this brutal psychological pressure cooker. The volatility spikes, and the risks get amplified for everyone on both sides of the market. If you're in a long position, you face the very high risk of getting trapped right at the market highs because of FOMO, the fear of missing out, which tricks you into opening new positions at elevated levels. On the flip side, if you're a short seller, the pain can be unbearable. You run the risk of emotional capitulation, potentially abandoning your positions and surrendering right before a major trend reversal finally occurs.
A prime historical example of abandoning trading discipline under that kind of emotional duress is Stanley Druckenmiller's experience during the dot-com bubble in 1999 and 2000. Druckenmiller initially initiated short positions against the tech sector after a prolonged rally, but the ascent just continued aggressively, and he faced immense FOMO pressure. When the market was nearing its absolute peak, his emotional discipline broke. He reversed his positions and went heavily long. And, well, you can guess what happened next. Shortly after this shift, the market completely crashed, resulting in a loss of nearly $3 billion within a year.
The core lesson from the Druckenmiller case is that the most destructive force in the market isn't necessarily a single directional misjudgment. No, it's the amplification of your risk exposure during critical moments due to emotional volatility. Strict discipline is necessary at current levels near 7,270. Long positions must focus on profit protection rather than aggressive expansion. And for short positions, patience is required. Scaling into new positions should be done gradually so you can mitigate the risk of maximum loss right at the tipping point.
All right, Section 3, Corporate Earnings Review. Let's unpack some specific tech and consumer results. Right now, we are observing a strong fundamental upward phase in the AI storage cycle, and it is showing up loud and clear in recent corporate financial reporting. Looking at SNDK's financial metrics, the company reported massive third-quarter revenue growth of 97% quarter-over-quarter. Furthermore, their expected median growth for the fourth quarter is projected to increase by another 35%. Despite these extremely robust fundamentals, the initial post-earnings price action resulted in a sharp drop. Why? Well, with the stock already up over 3,300% in the past 12 months and approximately 360% year-to-date, extensive market optimism was already heavily priced in. That triggered initial profit-taking before support buyers re-entered to push it to an 8% gain.
In contrast, Apple demonstrated robust forward guidance that significantly exceeded analyst estimates. While the initial post-earnings reaction was somewhat muted, the company's guidance for current quarter revenue growth of 14% to 17%, combined with gross margin guidance reaching up to a healthy 48.5%, ultimately drove positive price action. Despite an intraday pullback, the strength of this financial guidance allowed the stock to close higher with a 3.24% gain.
Shifting over to the social media space, Reddit reported exceptional first-quarter growth metrics. The platform achieved a 69% year-over-year increase in revenue, which marks its seventh consecutive quarter of revenue growth exceeding 60%. Net income reached $119 million, representing a massive 680% year-over-year increase. Additionally, active advertisers grew by 75% and global average revenue per user increased by 44% year-over-year. Just incredible numbers across the board.
Reddit also issued optimistic forward guidance for the second quarter, projecting revenue between $715 million and $725 million, and adjusted EBITDA between $285 million and $295 million. This is fueled heavily by AI ad targeting tools, with conversion performance ads now accounting for over 60% of total ad revenue. However, the stock exhibited extreme intraday meme stock volatility. It surged 14% pre-market, experienced a sharp drop at the open that completely trapped early buyers, and eventually recovered to close up 13%, though it does remain down approximately 27% year-to-date.
This erratic price action perfectly highlights the severe structural risks of earnings volatility. Estée Lauder saw a very similar story, spiking approximately 11% pre-market on an earnings beat and an upward revision in full-year guidance. However, the stock dropped sharply immediately at the open, trapping followers. The main takeaway here is that trading immediately upon an earnings release carries high risk. Observing the market for at least 30 minutes post-open is structurally advised so you can confirm the trend direction before committing your capital.
In the software sector, Atlassian beat expectations across the board. Q3 revenue reached $1.79 billion, a 31.7% year-over-year increase, beating the $1.70 billion estimate. EPS was $1.75, up 80% year-over-year. The full-year revenue forecast was also raised from 22% to 24%. All of this triggered a 29% surge in the stock price, facilitated by the fact that a prior 83% historical decline from its 2025 highs had effectively cleared out the market supply. That allowed for unencumbered upward movement, though the stock remains down 45% year-to-date.
Cloud communications leader Twilio also experienced a significant post-earnings rise of nearly 24%. Their first-quarter performance showed sales of $1.41 billion, a 20% year-over-year increase. And that was supported by massive net income growth of 350% to $90.13 million. Their forward guidance upwardly revised second-quarter projected sales to $1.425 billion and increased the full-year organic growth outlook to approximately 10%, continuing its solid rebound since 2023.
Contrasting these massive software beats, metaverse concept stock Roblox had a tough time, plummeting 18.3%. First-quarter revenue of $1.44 billion widely missed the $1.74 billion estimate, accompanied by a widened net loss of $246 million. Second-quarter projected revenue was also lowered to between $1.39 billion and $1.45 billion. This severe slowdown in user registration and revenue was directly attributed to the rollout of mandatory facial age verification, heavily restricting platform access for its core under-18 demographic.
So, in conclusion, navigating this current environment reinforces one absolute truth: developing disciplined trading habits and strong risk control awareness is structurally way more important than the outcome of any single trade. The market dictates a focus on robust indices and large-cap blue chips with strong cash flows. Conversely, structurally distressed small-cap equities, where fundamental deterioration lacks a definable floor, present completely undefined risks and honestly should be avoided entirely in favor of technically sound assets. With geopolitical noise and FOMO hitting peak levels, what are your disciplined habits telling you to do in this market? Let us know your thoughts in the comments below.